Good evening, everybody, and welcome to another edition of No Limits. My name is Scott Morganroth, and I am pleased to be joined by Kevin Wenke, my instructor over at Gold Coast School of Insurance. And Kevin and I have known each other for a few years, and I've had a lot of good instructors at Gold Coast. But I got to tell you, Kevin, you were a guy that wasn't just an instructor, but as time went on, you became a good friend. So I'm really
I
glad
appreciate that.
that you can join us tonight. So anyways, Kevin, why don't you give us a bit of an introduction about yourself?
Well, sure. Well, right now I'm freezing because I'm up in Olean, New York, and it is snowing like crazy right now. Wind's blowing about 15 miles an hour. But when I'm not freezing, what I do is I'm a big advocate for business owners. I've got several businesses myself, including the financial planning business. But one of the things that I own Decision Tree Financial, and I just wrote a book, and that's why Scott has asked me on the thing. The name of the book is The Sallo Strategy for Business Owners. And let's get started. Let's talk a little bit about this and tell some stories and
We're going to do
rock and roll.
that. And for all those individuals that wonder why I'm wearing an Indianapolis Colts
Yeah,
hat, oh no, Kevin, we got to do it. That's okay. I mean, there's some Wisconsin Badgers out there. It's a national show, Kevin. Okay.
yeah,
Jonathan
he's
Taylor,
gonna.
5 touchdowns, made life difficult for the Buffalo Bills. And by the way, for all that whatever it's worth, Jonathan Taylor played for the University of Wisconsin. But that said, let's get to it. All right, Kevin. Look,
Yeah, well, okay. One thing. Let me just. You can get to it, but this leads into a lot of stuff here. Let me tell you right now, the Buffalo Bills have helped me understand how to deal with adversity in my life because I never expect anything good to happen. Okay, rooting for the Buffalo Bills and being a professional Buffalo sports fan means that you are going to be constantly disappointed in your life. Just know that. Okay,
you're
so
not
I
getting
understand
no,
that.
sorry, you're not getting a whole lot of sympathy out of me for those individuals of Detroit Lions fans. You think you got it
Yeah,
bad?
that's true. But
That's
you
a
guys
little
have the
bit
Red
silly.
Wings. You have this. You have this Pistons. The Tigers have won before. Buffalo's never won anything. So you know what? Here it is for you.
But I'm
You know
going
what
to tell
that?
you one thing
You know
about
what that is, right? You know what that is right there, right?
what is
That's
it?
the world. That's the world's smallest violin playing for you, as a Detroit fan. See it right there. There it
Well,
is.
I will tell you one thing, and I had the opportunity many years ago when I was getting into the business, and I happened to write a story on Jim Kelly, the Heisman Trophy candidate. And we all know that
Yeah,
Jim
he's a UM
Kelly
guy. Yeah,
did
he's
some
a UM guy.
incredible things up there as well. So, with that said, we're talking about the Salo strategy, and I want to get
Sales strategy for business. Yes, let's do it.
that's what we're going to do. So, all right. So, Kevin, tell us about people when they realize that there's two assets the investment industry tells people to avoid because one is too risky and the other is too safe.
Too
Explain
safe, right?
it.
Too risky and too safe. So when you get into the mainstream media, not independent media, the mainstream media's got an agenda, right? They really are out to make money for the big companies, right? But here I am. So I just told you I was only in New York, but one of the places that's really close to here is St. Bonaventure, and one of my friends is a professor there. He's a finance professor, and he knows what I do. And he came to me one day and he says, I think that all somebody needs is to do two things. They just need two assets. You don't need to do these asset allocations where you're buying stocks and all these things. You just need two things. And I said, okay, really, what is that? He says, well, you need to have just a stable asset, right? And one of the things he said was use US treasuries. Now, what US treasuries are debt that the US government does, but it matures in 1 year. So it's like a CD that matures in 1 year, kind of, But um, so there's no interest rate risk. So if interest rates were to go up, you still got your money. So that's one. And that just protects money. And you got 90, 85, 90% of your money in there, and it's not earning hardly anything. It's really safe. And, it's not going to make you rich. So what you need on the other hand of that is something really risky that could go up 4,000, 5,000%, but it might end up going down to nothing and being absolutely worthless. But here's the thing, by going worthless, you've protected so much money that you're still getting the same type of gain when the market goes up. But if the market collapses, like, it has 2001, 2008, 2020 in March, it went down 35%. Can you imagine the peace of mind to know that the worst that you're going to do is lose 10%. So as you see it going down and down and down, you're not losing your money. You've already lost the maximum amount, which was maybe say 10%. So that other asset is something that is called a leap option. And the leap option is just something that is greater than a year. And it's a contract that allows somebody to purchase the stock market at a price, a predetermined price, sometime into the future. So for example, if the market, let's just say the stock market, everybody knows what the stock market is, and everybody wants to go up, and all that anybody really cares about when they invest is they want to take their money and they want it to go up in value so that they can make money on their own, right? So what a leap option does is says, okay, I've got, I don't know, 10,000, 100,000, whatever that is. And I want the right, it's at $100 today. And I want the right to buy it a year from now at $100, something like that, right? It can be $90, whatever. So now what happens if the market goes up to say 130, 110, 150? You have a contract that says you have the right to buy it at $100 anytime in that year. So if it's at 130, you can buy it at 100 and sell it at 130, instantly make money, right? Pretty cool, right?
Yeah.
Here's the other cool part. If it's at 100 today and it goes to 70 or 60 or 50 or 30 or 10, all you lose is your money. So now if you take the two of these, you've got the real risky, which is this leap asset, this leap option, and you got the real safe. You can see that you're protecting so much of your money. But here's the other part of it that most people don't understand. When you do that, you have a pile of cash where you can be a buyer when everybody else is selling. And if anybody's an investing person, they've probably heard that saying that a guy named Warren Buffett, they say Warren Buffett is this guy. He's, they consider him the greatest investor of our time, right? He runs a company called Berkshire Hathaway. He's about 90 now. But that's one of the things he says. He says, you got to be greedy when others are fearful and fearful when others are greedy. And so the Sallo system is a way of doing that. But the Sallo system isn't these two assets. All right. The Sallo system is stable assets and the leap option. There's a little bit more to this, though, because when my friend, the finance professor, showed me this, I looked at it and I was kind of skeptical at first because, as a CFP, and all these, different allocations and buying stocks and having put 15 years of watching CNBC and reading so many things, I was kind of finding it hard to believe that could be, that could work, even though he was an academic person. Well, why is the whole world doing this then? And it really comes down to money. There's no money into what I just said for the financial industry. It probably costs about $5. If you got $1 million, it costs you about $10 a year to do what I just said.
Okay.
I mean, who's going to promote that? You're not going to have a whole program on CNBC. It would actually destroy that whole network if everybody understood that's all you needed to do. I mean, that's the argument, right? I mean, when you get into investments, the indexing idea that a lot of people have, which is where you buy indexes, which are a basket of stocks that represent some segment of the economy. Those might be the Standard & Poor's 500, which is 500 of the largest companies in the United States. There might be the European, Asian, Far East index, which is, everything outside of the United States. But these indexes is something that a lot of people are promoting because they're inexpensive, but programming like the CNBCs or the magazines, and especially the financial industry, there's a lot of people that are saying, well, indexing doesn't work because you can never beat the market. And that's absolutely true when you think in a linear fashion. All right, what I mean by that is, if you just invest in indexes by themselves, they're going to do whatever they do, and you're never going to beat the market. You're actually never going to even count. You're not even going to average the market because there's fees inside those index funds as well. So the only way to really beat the market is what Warren Buffett does. And that's to be greedy when others are fearful. And the only way to do that is you got to have cash available to be buy when everybody else is selling. But you need to be in a position so that when the market goes up, you can get 100% of the gain as well. And so this is where the Sallo system comes in.
Sounds good. All right, well, let's go on to the next thing. So when used together, provide business owners with a unique opportunity to invest that will provide leverage to accomplish more for their efforts. Talk about that some.
Yeah. Okay. So I'm just talking about investing right now, right? And investing, when people think about investing, they think to themselves, all right, I have to take money out of my lifestyle today and I need to put it into something with the anticipation that it will grow into the future and be worth more for me. That's what people do when they invest, right? That's the thought process. They're never going to put their money into something. Hey man, I got $1,000,000 and I'm going to put it into something and I hope it goes down to 500,000. They're just never going to do that, right? They do the $1,000,000 because they want it to be worth 2, 3, 4, $5 million, right? Well, that's the idea here. Now I'm just talking so far about growth, but for a business owner, what I'm going to tell you, and as somebody that's worked with lots of business owners, a business owner's never going to make more money investing unless they bought Bitcoin back in 2009 for negative, whatever, how much it was back then. But in general, buying stocks, they're never going to make more money in investing than they are in their own business, right? Their business is like a goose that lays golden eggs for them. And there's a lot of moving parts in that, especially successful ones that have employees. And so with the Sallo strategy, not only can you get unlimited gains in the stock market, protect yourself from losses when it goes down, and have a pile of cash to be a buyer when everybody's a seller, you can actually use that money so that it is putting systems in place to make sure that that goose that lays that golden egg can continue to produce.
Sounds good. All right, so Kevin, let's just find that you don't have that you don't have to invest in IRAs, mutual funds, or stocks like you're told. You need to earn double-digit returns in the stock market. Elaborate on that.
Absolutely. So IRAs to me are a crazy idea, and people just kind of blindly put their money in. They think very short term, and there's a lot of CPAs out there that do the same thing. So let me explain to you something. So Scott, I got a question for you.
Sure.
All right, I got a $100,000 loan that I want to give to you right now. 100,000,
All right.
no questions asked. What do you want to know?
First and foremost, I want to know what the interest rate is and then the term.
Right. You want to know what the interest rate is and you want to know when you got to pay that back, right?
Right.
All right. So when it comes to 401ks and IRAs and things like that, what most people do is this. All right, I made $1. Now I can pay taxes on that dollar and I can have 75 or 70 cents or whatever that is, right? But if I put it into my IRA or my 401k, the government's not going to charge me that tax and I put the full dollar in there. Wow. I just saved money on taxes is what they think. So what's happening is that dollar grows. Maybe it's worth $2, maybe it's worth $3, maybe it's worth $4. But then what's the problem here is you just told me that you wouldn't take a loan unless you knew what the terms were or what the interest rate was, right? Well, when people put money into an IRA, what they end up doing is they're actually taking a loan from the government. The government's saying, hey, you don't need to pay us today. Just go ahead and keep that money for now and put it in there. And you're going to feel good about it. And it's going to go up in value, hopefully, right? But here's what we haven't told you yet. We haven't told you when you're going to need to pay that money back to us. And the most important thing is we haven't told you at what rate we're going to tax you on. Now, we've got you assuming, and one of the things my sophomore year in high school, my geometry taught me is the biggest thing that I remember in that class is that when you assume something, you break that down and you make an ass out of you and me.
Right.
But you don't want to assume what the tax rates are going to be in the future. Now, we've got a few things going on in this country right now. Some pretty big inflation going on. We have a ton of money being printed, and we have, tax the rich things going on. But, everybody knows that everybody's afraid that it's going to come down to even just normal people that just have a couple $1,000,000 or a couple $100,000. And so as we put our money into IRAs and we defer these taxes, we may be creating a ticking tax bomb. So for one of the things that if you look at things, and, just me talking here, if I look at the balance sheet of the United States government, they have around $30 trillion. I think it's like $32 trillion sitting in retirement accounts that they have a lien on. $32 trillion. Now we're in debt like $30 trillion, but they have a lien on $32 trillion of assets that they can change the rules on with the quick passage of Congress and start taking that money from people. Now, most people are anticipating that they're going to be giving this money to their children or their grandchildren or whoever. But let's face it, you put that money away in the IRA for your retirement. Well, what would happen if the government says, well, you're passed away now, you didn't need it for retirement, so we're just going to go ahead and take that now because it served its purpose and you didn't end up using it.
Hmm.
What? Huh? Yeah, well, why wouldn't they? They could easily do that. You're not going to argue it. You see what I mean?
Yeah.
But people are doing these things blindly. They never question it. They don't challenge the status quo. I mean, they think they do, but they don't when it comes down to it. And, so I'm just telling you, I'm not saying that it's bad. I'm not saying that all it's going to happen. I'm just saying that it could. And I'm just saying that you need to look at alternate ways to diversify yourself and to think differently so that you're not in a position where you're not in control. Because ultimately what you want to be, and the best way to be, is that no matter what happens, you want to be in control of your situation.
So
that's part of what a financial planner does.
Yeah, my question to you is, when you talk about term type of things that we just spoke about, okay, at what point do penalties come into play?
Oh, absolutely. Well, that's a whole nother thing.
Right.
The penalties that are on 401ks and IRAs are pretty intense. I mean, most people end up cashing them in. So they defer the taxes at their tax rate, but then they need the money. So they pay taxes again anyway, plus a penalty. And the government makes a fortune on that, it's not a bad thing altogether. All I'm saying to you is that I mean, having worked with thousands of people, I've seen people that have just continued to put tens of thousands of dollars just building this time bomb and never thinking of the potential consequences that could happen, because it never has. Since it never has happened, it must not going to happen, right? Well, that's kind of the definition of what a black swan was. Oh, the whole black swan idea, right? A black swan can't exist. This was the idea that until they actually saw it, and then they kind of figured out, oh, well, maybe it could happen, right? And thing is, I'm not Nostradamus, and neither are you, Scott.
Right.
And I don't know anybody that is. I'm just saying that, I don't necessarily want to be susceptible to any unforeseen circumstances that could happen. And so that's why I say, do you really need an IRA, or do you really need to put so much money into an IRA? And again, so as a business owner, the Sallo strategy shows you how to kind of leverage your business to actually have a diversified portfolio, have all that upside potential, have cash to be a buyer when everybody's selling, and to take advantage of that, but also not to put yourself in this position to have a ticking time bomb of your assets if you're in that tax bracket. So that's the idea.
Okay. All right. So let's learn how to reduce both direct and opportunity costs, so you don't find yourself wasting resources, putting more profits on your bottom line. And then I have a couple of questions I want to follow up with.
Sure. So you got to, so direct costs and opportunity costs. You just said two terms. People are probably going, what the hell are you talking about? Right.
Right.
So, so let me define what those are. A direct cost is kind of simple, right? Direct cost is, when it comes to managing money, it's, a lot of financial planners will charge 1%. So if you got $1 million, 1% means that they're charging you $10,000 a year. Now that's 10,000 that's removed from your portfolio, and is no longer available for you to use, and it no longer can grow or anything like that. And if you think about that over a 30-year period on just $1 million, that's 300,000. But really, if you think about the growth that it could happen, it ends up being closer to like $1.5 million. And that's the history of that. That's a lot of money, but that's direct cost. Opportunity cost is this. That is the opportunity cost is the benefit that you forgo for the benefit of another choice. So, for example, you can have $10,000, and you can say, "Well, I can take this $10,000 and have a killer vacation in South Florida, right?" Or and then that money's gone. Or I can take this $10,000 and invest it and hope that it grows. But if I invest it, I can no longer do my vacation. Okay, that's the opportunity cost of investing. So when you think about trying to reduce both direct costs and opportunity costs, all we're trying to do is do two things. We're trying to reduce the cost of the things that are being taken away from you to enrich somebody else, and we're also trying to get multiple benefits out of something. What would happen if you could go to South Florida on your vacation and make $10,000 or $15,000 in the process? Well, then that wouldn't be as much of an opportunity cost, right? Because you'd actually be making money on your vacation. All right. So here's the idea. When you can, insurance is another thing. Insurance is an opportunity cost too, right? Nobody likes insurance when they don't use it, right? It's a huge cost, right? Nobody likes writing that check or having that money deducted from their checking account, especially in South Florida for car insurance, right? I mean, South Florida's through the roof, and it costs a fortune to insure just even a little clunker car. And house insurance, homeowners insurance, right? Nobody wants it, but boy, the second they're in a car accident, the second that hurricane comes through and rips the roof off, they're glad that they have that backup plan. But it's very painful to write those checks, right, for the insurance. So if you could eliminate that, what if you could do something else where you're getting a protection that you would like, but if you could get it for free, but while you're simultaneously doing something else that you really want, like building wealth. And so that's where the Sallo strategy comes in. So one of the things we haven't talked about yet, Sallo. What the hell is Sallo? Well, I've told you, my friend Jim, who's the professor at St. Bonaventure, he had stable assets, SA, and he had leap options, LO, SALO. But there's two L's in the Sallo. The middle one is for life insurance. Now, I know a lot of people think life insurance is just the worst thing and the absolute, it's the worst product there is. I'm going to tell you it's the best one. And here's somebody that owns their own registered investment advisory. All right. So I have my own. I don't work for anybody. I would make money on the fees, the opportunity cost, the direct cost, if I charged the type of fees that a lot of people do. But what I try to show people is how to capture a lot of those costs by using life insurance to protect their business. So as a business owner, a lot of people depend on key people that are there, that are working for them, that might have all the connections with their customers, that may know all the processes, et cetera, right? And one thing that I see that a lot of people do is they just kind of hope and pray that nothing happens, But the fact is that if they're good, a couple things are going on. The competition probably wants them and are probably trying to actively take them away from your business. And there's always the risk out there. So not only do you have to worry about you as a business owner of, having something awful happen, like a premature death or a disability or sickness or anything like that, you also have to worry about your employees, and you're responsible for that. I mean, you're the leader of your company. And so you got to start thinking about, if you haven't already, how can you make sure that you're taking care of your people, but also making sure that they can continue to take care of you. And that's where insurance comes in. And I've always asked people, I said, if I could just give you this insurance for free, would you take it? And most people are like, oh, absolutely. And of course, that's absolutely true. And, one of the things, with that we found out after September 11th is that, all the folks that had that happen when the towers fell down, is that they were very underinsured. But once the government wanted to give them the money for that, they got 1.7 million. Everybody took it because it was free. So we all know that that will happen. And I don't know anybody that wouldn't take insurance if it was free. But there's where the Sallo strategy comes in. See, now I'm going to use this whole life policy, which whole life's really cool. Just a couple of weeks, just a side note. Today's the 22nd of November. And do you know what happened in November in 1975, I believe it was, on Lake Superior?
You tell me. I know what happened in 1963.
Well, okay, so it's a Gordon Lightfoot. The song is called the Edmund Fitzgerald, right? There's a giant ship that sank in Lake Superior. But the thing I'm telling you that story, I just learned this, which I thought the company that owned that was Northwest Mutual, which is a life insurance company. They own the Edmund Fitzgerald, which was taking iron from Wisconsin to, I think, Cleveland was where it was going. You see, when you own these mutual life insurance companies, what you are is you're actually owning the company, because a mutual life insurance company is actually owned by the policy owners. And it's a little different than a for-profit company, because they're only in business to just provide insurance benefits. And so what they do is they take your premiums and they invest in all kinds of different businesses. For example, shipping or real estate or other insurance lines. And you, as the policy owner, receive dividends when they earn more than they need to pay out in insurance benefits, and you get to keep that. Now, they're not guaranteed, but you're kind of owning, when you have a mutual life insurance company, you're kind of owning these. It's kind of like a hedge fund with all kinds of different businesses that happens to provide insurance benefits to protect your family and your business on the side. So that's kind of cool in and of itself. But I just learned the thing about the Edmunds Fitzgerald, so I wanted to save that. But mutual insurance companies, they can have dividends that are, I think the highest that are in history was like 12 and a half, 13%. So you're earning 13%, and it's based on interest rates mostly. But and right now we're in a low interest rate environment, so the dividend rate is closer to like 6 and 7%, which is still all right. And then when you take that, when I was talking about this two asset strategy in the beginning, the problem with the treasury bills is that they don't earn any interest. By replacing that treasury with life insurance, now you're actually increasing the return. So you get the same benefits that you had. So now you have the stable asset, you have the sum of your money in the treasuries, you have some of your money in life insurance, providing you with all those benefits that the life insurance does, plus giving you access to all those different investments inside of there. And you have the leap option that allows your money to potentially grow 20, 30, 40% when the market goes up, when it goes up that much, while also protecting yourself if it does collapse again, which we all know it's going to someday. We don't know when. That's kind of the problem. But you want to be in a position where you're in control and you have options. I mean, you have choices, I should say. And cash is king. And so when you have these two other assets there, and you can be like, crap, the market's going down. I lost 10%, but man, it looks like it's kind of stabling out. Maybe I should double down. And you can double your money. And I got a picture in the book that shows how that could work. And you're talking about power. I mean, can you imagine how that would feel when everybody else at the parties you're talking about is like, yeah, my investments are down 60%, 70%. I don't know what I'm going to do. And you're like, oh man, that sucks. Well, I doubled my money. What? How did you do that? Yeah, I didn't follow the status quo. I did it a little different. That's the investment side. Now let me go back to the business side. Let's imagine that something happens in your business and you did the Sallo strategy and you do have the insurance products in place and you don't have to miss a beat if something happens. Now, nothing happens, which hopefully nothing ever happens. You're just better off. But if something does happen, you're going to be able to look at everybody else that's in your company and say, it's all right. We had systems in place so that we're not going to miss a beat. And that's powerful. And that's what this is all about.
All right, so let me bring up a couple interesting points. By the way, what did happen on this date in 1963, the assassination of John F. Kennedy, for those that are history people, that occurred in Dallas, Texas, and I actually had a chance to see the site down in Dallas. It was pretty unbelievable.
You know, I'll tell you a quick story about my family. My cousin was the emergency room doctor. He didn't see Kennedy, but he saw. He was the emergency room doctor who saw. What's I want to say? What's his name?
Well, I know that there's a police officer that was shot.
No, the one who shot
Oh,
Kennedy.
Lee Harvey Oswald or
Oswald.
Kennedy?
Yeah, Oswald.
Okay.
My cousin saw Oswald in the Dallas hospital.
Unbelievable.
His name is Harvey.
Oh, there you go.
Steve Harvey. And yeah, that's, he was here. He came to I met him when I was like 12. And anyway, that's just another little side thing.
Well, you talked about your buddy, the Fitzgerald guy. I'm talking about John Fitzgerald Kennedy. So we have a Kennedy, so we have a Fitzgerald connection. So I want to go over a couple points that I want a brief explanation on. And I mean very, very brief. Okay. So what I want you to do is give a shortened version, Kevin.
Shortened, man. You're asking me a lot.
Oh, I know, but I have to because we got other people that are making sure that even though you're really well-rounded in it, a lot of individuals are not. So give me a brief explanation of what is an opportunity cost, and I mean a very brief one.
Yeah, it's the benefit that you forgo by making another choice with your money. So again, that goes back to should I go on vacation with my $10,000 or should I invest it? If I go on vacation, it's gone and I can no longer invest it. That would be an opportunity cost.
And then what is a direct cost?
A direct cost is just the money that you spend to do something. For example, it costs money to buy insurance. That's a cost that you have. Or when you invest, the fee that you pay for that investment services that's inside of the mutual fund or whatever. It's a cost that is being removed from your net worth for the service that you're receiving.
Very good. So, all right, Kevin. So let's just see how to be positioned to be a buyer when everyone wants to sell, so you can buy low and sell high.
Exactly, and I kind of hit on that earlier. If you just put your money in stocks, let's say you got $1 million, whatever it is, $100,000, whatever that is, and you own stocks, and it's all in stocks. Well, the stock market average is 11%. It's maybe 13% over the last 15 years or so. But the point is that you're all in, just like a gambler, and it goes up. But if it goes down, you're still all in, and you don't have any cash. Cash is king. And so at the Sallo strategy, you still have 80% of your money sitting there available to be a buyer when everybody else is selling, because the leap option is doing all of the heavy lifting for you. It's like a rocket ship. In my book, I got pictures of rocket ships because it can go up 300, 400%, 500% in a year, but it can also be worthless. But that worthlessness is a sacrifice to protect the rest of your money. So they work together. And I don't know, I in the book I kind of do. Do you remember back in the 70s and 80s there was a commercial. One guy was eating a chocolate bar and he's walking and he's eating his chocolate bar, and another guy's got a spoon and he's eating peanut butter out of the peanut butter jar, and they come around the corner and they collide, and the chocolate goes into the peanut butter, and they start yelling at each other and they say, "Hey, your chocolate fell into my peanut butter." And the other guy says, "No, your peanut butter fell into my chocolate."
Never will.
Yeah. Right? You remember that? All right.
Yeah.
Well, that's the thing with leap options and the life and the sale asset. They're two things that work great together. Okay. They serve a purpose. They complement each other perfectly for what we're trying to do. Whereas when you're in stocks, it's kind of a humdrum, it does what it does, but it gives you no flexibility. And I read a book, and the guy said in it one year, I remember, I'll never forget. It said, "Blessed are those that are flexible, because they will not get bent out of shape. And so it's all about being flexible and being able to be in control of your life.
Well, I mean, like you pointed out, the whole objective is you want to buy low and sell high. That's what it's all about, making money.
You know, and that's that you're absolutely right. And I always tell people when they ask me, hey, financial planner, what do you do? I tell them there's two things that you do: buy low and sell high, and spend less than you make.
Yeah, you know,
That's
it's
it.
funny how you
That's
talk.
it. That's it. That's it.
It's funny how you talk about that because as I once in a one of my side businesses is I like to buy real estate domain names if I can get them for less money and they want to buy them down the road if they want to go. It's same when you conceptualize it, there are some similarities to it. So when we put things in perspective, Kevin, okay, we talk about new ways to be efficient, which will help move you towards continued success. So why don't you put into perspective what that's all about?
Sorry, repeat that again. What is it?
Sure, you're talking about discovering new ways to be efficient, right?
Mhm.
Okay, and then that'll help you move forward towards continued success. That's that what the whole objective is behind
Yeah,
it.
that's that. I mean, that's really just summary of everything, right? I mean,
Right,
that's
exactly.
all we're trying to say is that, if you step back and look at things and ask why you do things,
Right.
and as a listener, I'm not sure where you're at, um, but you know, I'm just going to say that there's a constant war going on for your money, and there's people that are actively trying to just beat you over the head with a message to get you to act in a certain way that positions them to make money and positions them to be in control, which means that it's you that lose money and you that lose control. And so all I'm saying is you are you Inc. as a person, right? And you might have a business. And if you're not a business owner and you just have a job, you're still you Inc. You are in charge of yourself. So step back, challenge the status quo, and ask why things are. Ask who's profiting from this, and ask is there an alternative on what you could do that would make it better for yourself and not necessarily transferring that wealth and time to somebody else so that you can have more time for yourself, you can have more money and better peace of mind. And that's really what it's all about. And it's a crazy thing. I mean, I got to tell you, I mean, I know we got to wrap up here, but I'm not a financial. I was never wanted to be a financial planner. I actually resisted. Now, my grandfather worked for MetLife in the 1947 and 1972, and I knew he did well. He retired when he was 55 and had a house in Zephyr Hills, Florida, and then he lived up here. And just never appealed to me. I like to know how things work, So I probably get that from this podcast. But so I have a biochemistry degree. So I got into, I liked chemistry, I liked biology. I wanted to understand how things worked and ask why. That's kind of me. But I ended up becoming a financial planner because of what happened to me. And see, what happened is I was working for Siemens, uh, and I did water treatment all over. I did all the space shuttles water. I did all the NASA's water. I did all the SeaWorld's water. I did all this water, all water, right? But I also had this entrepreneurial part of me, and I bought cell phone stores in Melbourne, Palm Bay, and Vero Beach. And I put all my money in there. And when I made a lot of money I say a lot of money, I mean, relatively speaking, for a 20-year-old, $250,000 is a lot of money. And I got out of the market before it crashed after 9/11, after dot-com boom or dot-com bust. And I had this cash, and so I put it into these cell phone stores. And but then what ended up happening is I fell asleep watching a hockey game. I was in Melbourne, fell asleep kind of like with my head kinked like this, and I woke up sore neck. I started digging into my neck, and I felt a lump in there. And I thought I screwed a tendon up or something like that, right? And I said I got to go to a chiropractor, and my wife at the time told me I needed to go to the doctor, and I wasn't going to listen. But then she pretty much told me I was stupid, and so I tucked my tail between my legs and did go. And they did a CT scan, and those little lumps ran all the way through to my chest. And it turned out that I had a lymphoma. And so when I had lymphoma, uh, what ended up happening is I lost these businesses. Long story, I won't even get into that, but I lost everything. And so going through chemo, I luckily had health insurance, but I didn't have a lot of the other things. So I lost all my money, lost, 100,000 of other people's money, and all of my money. And I just started to think to myself, what could I have done differently? And then I was at my sister's wedding in Ithaca, and I was sitting there with my grandmother, who was 87 at the time, and I was telling her my whole story about how I just was, you know, just all fraud over this and stuff like that. And of course, I put 50 pounds on because they were pumping me full of steroids, but I was going to survive. My doctor told me that if I do what he tells me, I was going to survive. And so my grandmother listens and she says, "Honey, you need to go in an insurance business." And she just knew how to say it, and that's how I got into the insurance business after all this happened. And so that was 2003, and then I couldn't get insurance for myself for about 10 years, and then I got it for myself in 2004. And this is what's crazy. I tell people I'm my own best client, because in 2016 I started having problems swallowing, and I thought it was a hernia, didn't know. Went to the doctor. They did they stuck that tube down my thing to do a scope. Turned out I had a massive tumor in my esophagus. I had esophageal cancer, and I didn't miss a beat. I mean, I had everything in place so that I had the best care. I was able to go to Johns Hopkins, MD Anderson. I started at Florida Hospital, and then I ended up at Roswell Cancer Institute in Buffalo. But I didn't have to worry about money. I mean, if they told me I don't have to Google my survival chances, so I did, and it looked like 20%. But you know what? I didn't have to worry about money at that time like I did back in 2003 when I had it. I had everything in place, and I had a baby that year too, which was crazy. But here we are. It's 2021. Halloween was my 5-year anniversary from what they did. They did an esophagectomy where they removed half of my esophagus. So I'm a 5-year thing. I lift weights. I do all kinds of stuff. The point is that it's the peace of mind, and you're going to have a hard time telling me that what we do is not important. But what I try to tell people is that you could do the things that put yourself in that position without having to spend money and reduce your lifestyle when you step back and challenge the status quo. And that's really the most important thing that most people just cannot comprehend, because we're so conditioned that you have to spend money on things. And if you look at it and you look at a big picture and understand how to integrate and coordinate everything together, man, it all can take care of itself. You can have more protection, you can have more income, more net worth growing, and just that peace of mind to know that no matter what happens, you're going to be all right.
All right, so well, obviously you're a two-time cancer survivor. So what I want you to do, Kevin, is let people know how they can get a hold of the Sallo strategy.
Sure, that's easy. Just go to thesallostrategy.com and download it. Right now, it's free. Now, I'm still kind of in this beta and it's only downloadable, but I'm going to be publishing it eventually. And it's probably going to be for $30. But, what I do is right now I want you to read that, and I want you to just understand it. And it's pretty simple. And if you ever need to talk to me about it, it's all about implementing it and understanding the big picture. I try to have a lot of fun with the people that I work with. And, again, I know that finance and everything, I think I said this earlier, it's Charlie Brown's teacher, it's wah, 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 wah. But if you understand how it impacts you and how you can do it and you have a good time, and when you're working with somebody, you can understand how to implement that and put things in place that you otherwise wouldn't. And so, I mean, you got to know me a little bit here. I've known Scott for a long time. And if you think that that's something that you can do, then that's what I do. I work with about 100 people a year, 100 new clients a year to put these things in place. That's about the maximum I could do, because it takes a lot of time. But you know what? The people that I work with, I have a good time with. And if you see yourself, you could have a good time with me, then that's what you got to do is read the book, understand how that works. And if you see yourself doing it, let's get together and let's implement a plan and put yourself in a whole completely different position than you are now, so that you can have that peace of mind, look in the mirror and know that you're doing the right things for yourself.
So, all right, so once again, go ahead and repeat the information.
Yeah, it's the sallostrategy.com. The sallostrategy.com. TheSallostrategy.com.
Beautiful. All right. And just so you know, folks, this is tonight's special guest is Kevin Wenke. This is No Limits. My name is Scott Morganroth. Glad to have Kevin with us. Just so everybody knows that if you want to go ahead and see this broadcast on YouTube, please subscribe to the South Florida Tribune YouTube channel. It is no cost. If you're looking to listen to the audio portion, after all, we have the audio portion as well. You go to Spreaker, go to iHeartRadio, Spotify, Apple Podcasts, Google, or wherever you get your podcasts. You can also find it on www.southfloridatribune.com. If you want to follow us, you can also go ahead and follow us on Twitter at Tribune South. So if you're on Twitter, go at Tribune South, and we'll put these updates up there as well. So, and also to email us, you can email us at southfloridatribune@gmail.com. So numerous different ways to get a hold of us. And if you have any questions that you want to go ahead and send to Kevin, please send them to southfloridatribune@gmail.com, and I'll make sure that Kevin does go ahead and get those for you. So any that way that we can do it. So Kevin, it's been a pleasure having you on the broadcast tonight. Any closing thoughts before we call it a night?
No, we went over everything. I really appreciate it, Scott. I hope that everybody enjoys it and learn something, a little different. It's all about challenging the status quo.
Well, again, you know what, when you're talking about money and you have a certain agenda that you're looking to try to help individuals alleviate those concerns, then it sounds like the Sallo strategy is a very good read. And I'm glad that you have an opportunity to go ahead and share that. Now, will this book be over in any bookstores locally, or is it something that you go ahead and order? Or
yeah, when I publish it, it'll be on Amazon eventually. That's where it's going to be in a bookstore. I doubt
Amazon.
it.
And I'm assuming that it's a very simple read, right?
Yeah, again, I had illustrated about 60 pictures in it, so it's
Beautiful.
a pop-up book.
Well,
That's I forgot to bring that up. My ex-wife told me that if I could write a finance book that was a pop-up book, I'd make $1 billion. So this was my attempt to make a pop-up billion. It's not necessarily pop-up, but it's cool pictures that just illustrate things that make those complex concepts simple to understand.
Well, lots of people are visual. If a pop-up book is easy reading, then you certainly incentivize it. Just like when we do these shows, when we do audio or video, depending on how people observe it, it's as well. So everything's about visual, trying to make things a lot easier. So that's what it's all about. So anyways, Kevin, once again, thank you very much for joining us on this edition of No Limits. My name is Scott Morganroth, and I am the CEO and publisher of the South Florida Tribune. Once again, our website, www.southfloridatribune.com. So feel free to find anything that we do on there as well. And my incredible wife, Candy Ebling, does a marvelous job putting this site together, both putting all the broadcasts on there as well as posting the content. So Kevin, look forward to seeing you when you get here in Florida again, and also looking forward to bringing you on other different platforms as well. So again, thanks a lot for joining us tonight.
Excellent. Okay, thank you.
Good night, everybody.